Hello and welcome to the Mutual Fund Show. I'm your host Neeraj Shah. Yesterday, we spoke about why having too many funds in your portfolio may or may not be a good idea. The two guests who were there on the portfolio were of the opinion that having too many funds defeats the purpose of having an optimum portfolio. Now, our guest today is somebody that I've looked up to for figuring out what is the right decision to do when it comes to mutual funds. He's done some remarkable shows with us, including talking about how to repay your housing loan using mutual funds as well. I mean, that was one show that everybody had loved. And I thought it was best that after doing a show about why you should not have too many funds, we get Vijay Mantri to try and tell us that, okay, if it is decided that we shouldn't have too many funds, how should one go about building out the mutual fund portfolio in the first place? We might not have too many graphics today on the show, but still, listening to him should give us an insight or two or maybe more. He joins us right now in our studios. Vijay, great having you. Thanks for taking the time out.
Thank you very much, Neeraj, after a pretty long time.
Yes, but good to have you.
Thank you.
So, yesterday, and your opinion may differ, but yesterday there were two experts here and they explained very beautifully about why people should not have too many funds. One of the opinion was that a lot of times people just go out and subscribe to NFOs because of marketing efforts, etc. and stuff like that. Sometimes they just look at the best performing fund, buy it and then forget it. And therefore at point of time people have 25, 30, 40 funds in their portfolios. And therefore they are effectively mimicking the index because they are virtually buying the whole index. So today we thought we'll try and figure out that if somebody's starting from scratch, right, and wants to build out a portfolio, how is it that, or what is it that the person should do when building out a portfolio? Let's stick with an equity portfolio for right now. We'll add the debt layer if time permits.
So in my opinion, the way investors should look at is that figure out how equity will generate return. The equity generate return if there's a corporate profit grows, and the corporate profit grows if GDP grows. It will, sometime it may lag, but over a 10-year plus period, it goes like absolutely clockwise. So once you buy equity, you need to be very clear that you're buying for 10 years. So once you buy for 10 years, very honestly, the fund performance doesn't deviate too much between various categories. Okay, sometime it will depend. Sometime it may vary point to point, but over a 10-year rolling return basis, we have seen the fund performance does not deviate too much.
You mean different funds within the same category?
Yeah.
Okay.
And if you want to have a lesser number of fund, it's very clear that you buy few flexi-cap fund, few large-cap funds. And why you buy flexi-cap fund? Because flexi-cap fund invariably will have 50% plus into large cap, then 25% into mid cap, 25% to small cap. So you already get all these things. Sometimes people add flavor of thematic fund or sectoral fund because they believe they can make more money. But let's look at this way, that suppose you want to own banking and financial services fund. Nifty itself, you have a 35% weightage to BFSI. So in any case, you have BFSI in your normal portfolio. Suppose you want to go and buy IT fund. How much you'll buy IT fund in your portfolio? 5%, 10%? Nifty already have that kind of weightages in the portfolio. But what happens when a combined portfolio see a return of say 15%, and thematic and sectoral funds see the return of 25%? Investors tend to gravitate toward that particular. This is a global phenomena. Whenever investors see the return, they chase that particular asset category, including within the fund category.
Right.
But if you have to look at identifying what was the reason for performance of this particular fund, you will figure out the fund was overweight on healthcare. That's why it did very well. And you will see similarly, healthcare indices did very well at the same time. Healthcare-oriented fund did very well at the same time. So if you're not bothered, you are disciplined, 4 flexi-cap fund will do for throughout your life. But that is not how human beings work. We don't have 4 pair of clothes. We don't have 4 pair of slippers or footwears. So we'll invariably add varieties. So this is what will happen.
Okay. So you are saying if somebody can really maintain discipline, then having 4 flexi-cap funds will do the trick on the equity side.
You don't need to do anything very honest.
No thematics.
Nothing is needed because flexi will capture everything for you. So for instance, let's look at manufacturing is the current theme, and I believe it is a great theme to look at investing.
Yes.
But manufacturing have a 600 companies. There's a auto companies, there's a capital goods company, there's an infrastructure company, and all of them are part of their portfolio in any case.
Yes.
And how much would you invest in a thematic fund per se? There are many themes. FMCG is theme, healthcare is a theme, pharma is a theme, Railway is a theme, PSU is a theme. How many themes would you invest in? So if you invest only in thematic fund, you will have minimum 10 fund only theme basis. Now what happens when the fund doesn't deliver? That is the worst time to take money out, but invariably client will take money out at that time. Second thing, let that job remain in the fund manager's hand only, no? Why you want to then churn? Today this theme is not working, I would like to take money out and put somewhere else. Then you incur stamp duty, you incur STT, you incur taxation as well. Let that job be with the fund manager. So 4 fund is the best, 4, 5, 6 fund, Flexi-cap are the best, but client will not listen. आप कितना भी करो, they need some thematic thing, they need something, small cap चल रहा है ये दे दो, quant चल रहा है ये दे दो, international fund दे दो. So people will do.
But let me play the devil's advocate. Flexi-cap funds typically have a large cap bias. If I believe that if I am happy to hold a fund for more than 5 years, let's say 7, 8 years, and I don't withdraw money, मुझे ये पता है मेरे बारे में, मैं पैसा निकालूंगा नहीं. Can I add a small cap fund or 2 to that mix? Let's assume I'm starting off with 4 flexi cap funds. Now I want to do a further SIP. Should I add a small cap fund?
See, you should do that, but provided the best time to add the fund is when the historical returns are looking very bad.
Okay.
Today, historical returns are looking very good as far as small and mid cap funds are concerned. If anybody comes and tell me, I would like to own consumption and FMCG fund right now, I believe this guy can hold for a long term. Anybody who see high return and they say, I would like to invest and hold it for long term, is a story. Reality is very, very different.
Okay, fine. Okay. So let's assume I'm not believing in stories, but I actually am. So when I started with 4 flexi cap funds, historical returns are not great right now. Maybe in 1 year's time, if they become good, should I add a small cap fund or 2 to the mix?
Not at the current market.
Not at the current market. Let's say 1 year, if the small cap performance lags, are small caps a good addition to that mix?
Yeah, mid and small caps are always good addition to that. But in any case, flexi cap will give you 25% in any case. Cap. And how much you would like to overexpose yourself to the small cap?
Yeah, but flexi cap may not have necessarily 25%, right? Some of the flexi cap funds I've seen have 80-85% exposure.
So then
to
you go for
caps.
multi cap, which have invariably have 25% exposure.
Okay.
But I'm telling you, whatever, see, the best food is dal, rice, vegetable,
yeah, but people
chapati.
still want everything else. Sure. Okay, I get your point.
It's very easy to suppose I would like to invite you to my son's wedding and I'll give you dal chawal and what मंत्री जी ने किस तरह की शादी रखी यार कुछ खाना ढंग का नहीं था. So I had to give chappan bhog.
Okay. Yeah, but we are trying to ensure that people don't go for the chappan bhog, but still try and get a little bit of excitement aside of the 4 flexi cap funds as well. So that's where I'm coming to. So let's assume 3 or 4 flexi cap funds. If they get the timing right, maybe 1 or 2 small cap funds, if you will, if you agree. Anything else? I mean, a lot of people talk about how people should, if they want to be exposed to multiple asset classes as well, instead of trying to invest in individual funds, buy a multi-asset fund. Do you subscribe to that theory?
This is a great idea. To buy multi-asset fund is a great idea because it is far more efficient and tax efficient as well. And the fund manager take a call whether to go into silver or gold or debt or equity. So that is a much, but the client don't have the sense of ownership in multi-asset fund. And we see different personal behavior of people. So suppose you have a gold jewelry and a gold ETF. If the gold ETF doesn't deliver return, what will you do? You take money out, but at the same time, you don't go and sell jewelry. So, and same thing about any product category. So multi-asset in my opinion is a great asset category, but the client don't get the same kick when they look at investing. So if you ask me right now, which are the great theme to look at investing, and these, in my opinion, these are less riskier. One is banking and financial services. Second is healthcare. Third is FMCG and consumption theme, which is not played out. And I think if the Modi come back, I think that theme will get played out. And manufacturing and business cycle in India, China plus one strategy. So these are great strategy, but I will tell you the fundamental question is not whether you put money, which fund, which category, is how much you invest as a percentage of household saving and how long you stay invested.
What's the ideal number there? How much should one invest as a
So
percentage?
I did some number crunching, very simple. If you put 20% of your monthly income into SIP and hold it for 20 years, you don't have to worry about retirement at all. Your retirement is taken care of completely. So just put a simple number. If you do SIP of 10,000 rupees per month for 20 years, from 21st year, you can take out 1 lakh rupees per month for next 40 years. Okay. So that is the magic of SIP, but you have to hold it for a 20-year period. Now you can add other goals in your life, kids' education, holidays and all that. So I would say start with minimum 20%, and if you're able to take up to 50% of your gross net take home after taxes, if you can put 50% into SIP, no financial planning very honestly is needed, because the kind of wealth you will create, it is going to be humongous. One big decision is that how much you are putting in equity mutual fund and how long you are putting into equity mutual fund. Because in 30-year period in India, the worst equity mutual fund has delivered 13.85% return. So let's assume that you're not going to get the best, you're not even going to get average, you get the worst 5 fund in your portfolio. Let's assume you're going to get the worst 5 fund in your portfolio. That will do job for you.
Wow.
The most important thing is that how much saving you have put in equity mutual fund and how long you would like to stay invested. Rest of the things are just to fill the, more chatter we have, more discussion we have. But these are the two most important. Like as you know that, how to keep a good health, how much time you give for physical activity, and whether you're able to control your food intake or not. Rest of the things are actually just for a discussion.
We got to do a separate show on this, by the way. But as is the norm on every mutual fund show, a lot of people send queries. We try and take 1 or 2 queries so that people feel the connect with the show as well. So I'm going to take a couple of queries here.
Please.
Yeah. The first one is from Ram. Ram is aged 33. His goal is, well, I think maybe retirement, maybe. Ram says that I have 60% portfolio exposure in PPFAS and the rest in direct large cap funds. He would like to add 1 or 2 more mutual funds, but even having 3 mutual funds makes him feel that it would be over diversification. What should his approach be as a long-term investor? The current value of investments, Vijay, in PPFAS is about 23 lakhs. In Parag Parikh Tax Saver is about 5 lakhs.
So I think how much you like somebody, don't fall in love with anybody. Okay. So I would never recommend any of my investor to put more than 20% in a single scheme, single fund house, if you're in extreme love with that person or that organization, because nobody can be consistently right. And second thing, a fund manager or portfolio manager who catches one leg of the market rise invariably do not get the next leg of the market rise. We have seen in the Indian market, the guys who made big money in the public market, we know their name, but they completely missed out on the private market. So this happened invariably. So in my opinion, having 1 or 2 fund is not enough. For instance, I'll tell you, the gentleman is talking about Parag Parikh. Though it is a 1-year period, but just to give perspective, in 1-year period, Parag Parikh delivered 35-36% return. 1 year back on one of the platform, direct platform, people were buying Parag Parikh and selling Motilal Flexi-cap fund. But in last 1 year, the performance difference between Parag Parikh and Motilal is 18% in favor of Motilal. So don't fall in love with anybody in the market. There are no God in the market.
So very quickly, we are out of time, Vijay, but what should he add then?
I think he should add to a couple of other Flexi-cap. And I can suggest the name of Flexi-cap.
Can you please?
They can look at HDFC Flexi-cap is a great fund. They can look at ICICI, a Value Discovery, in my opinion, is a great fund. They can look at Vitalk, Bajaj, Helios. They are great fund houses managed by great people. Look at a couple of funds from these fund houses, but have minimum 5 funds in the portfolio.
Okay, so have 5 funds in your portfolio. Ram, we don't have more time, but just very quickly, have maybe 4 or 5 funds in your portfolio. Ideally, Vijay says, don't put more than 25% or 20 or 25% of your portfolio into one fund house. So you may want to consider that kind of diversification as well, if you are indeed staying invested for the next 5 to 10 years. So just keep this in mind. This is a risk-adjusted return strategy that Vijay Mantri is giving to you from the experience that he has. But viewers, we are out of time completely on this show, so we will have to call it a day. Maybe some of the other queries will be taken up next week. But thank you so much for tuning in to the MF show today.